let's get into it. So Broken Wing Butterflies, entry and management. First off, just for the entry, Broken Wing Butterfly consists of a long spread financed by selling a wider short credit spread. Because you're doing this for credit, you have no risk to one side. If you're doing a regular butterfly where it's five strikes on both sides, you'd do that for a debit. You'd have a tight window to hit. Because you're collecting a credit and adding risk to one side, you have no risk to the other side, which makes this into a high probability trade with no risk to one side. So that's set up. Of course, we're looking for high IVR, high IV. Since your net short premium, we want to sell premium when volatility is high. It allows us to go further out of the money on the distribution curve. It allows us to collect a bigger credit for the spread. All those things are positives for this setup. Synthetically, you're selling an additional spread. So if you're doing like a 5x10 butterfly, Broken Wing Butterfly, you're synthetically selling two $5 wide spreads, your risk being one of those $5 wide spreads on whichever side you're doing. For the spreads themselves, we're typically looking to do $5 or wider. Of course, this depends on the stock price. So a $5 wide spread in, a higher priced underlying or in like SPY or, something like that, that's a couple $100. That's a tighter spread relative to a $5 wide spread that's in, $100 stock. It's relative to the stock price. So, you have to kind of consider that. But generally speaking, $5 is kind of our wheelhouse for, or at least as tight as we'll go for these butterflies. And that's, of course, considering the stock price there. Typically, we want to put the short options around the 20 or 30 delta. This is pretty standard for anything we're doing, whether it be strangles or naked puts or naked calls or butterflies or, whatever, iron condors. We're typically looking around that 20 to 30 delta. If you want to be a little more conservative, go further out of the money. Sure, that's great. But for us, normally around the 20 or 30 delta. In terms of the duration, so with butterflies, you have that long spread, which is the meat of your position. You have a little more wiggle room in terms of the ideal entry point, with a shorter duration. Like if you're looking in that, in the next 2 weeks expiration, you're going to be closer at the money. You're going to collect a lesser credit. You'll probably have a tighter long spread. If you're looking at a 45-day time horizon, you're going to have wider spreads. You're going to collect a greater credit. You're getting more extrinsic value for those positions. So you've got a little bit of a variable here, but you just have to keep in mind that these positions are longer duration trades in that you have to hold these, for a significant amount of time. Usually the entire duration if you want to get close to that full max profit on the position. But again, your entry point for these, it's a little subjective. I like to be in the 20 to 30 day range rather than the 45 day. If you want to go shorter duration, I don't hate that either. And then overall, you're looking at a high pop trade, so it's a high probability of success, but you have a low probability of actually hitting that max profit. So when you see the max profit of $500 and the max loss of $500, the probability of hitting $500 in max profit is very, very small. But, it's a high probability of keeping 20 cents or 30 cents, 50 cents maybe on that position overall just because of having no risk to one side.
Yeah, and the point of the duration, I think the easiest way to think about it is what your intention is with the trade. So if you're going out 45 days, you're going to be able to collect a higher credit up front. You're going to have more opportunity to turn this into a free butterfly, which we'll cover in just a second. Yep. With a 1 to 14 day or something shorter term, you're not going to be able to pick up a lot of credit. It's much more of, I think the stock is going to my short strike within this time frame, where the 45 day is more, sure, I benefit if the stock goes to my strike as time passes, a lot of time passes, but if you're trying to turn into a free butterfly, going further on time, you have more leeway to do that, where short term, you don't. So I would think about it like that.
So we'll jump to the next slide here. So this visual is one that I've used a ton of times. It's my favorite visual, but this is how you should think about these trades. And on entry, you're going to be looking at somewhere in the 80% probability of success range. But realistically speaking, here's how your probabilities kind of set up. You have around a 60% probability of being out of the money on this position, where whatever credit you get on entry, let's say you do this for 20 cents or 50 cents, 60% probability of keeping that credit, of just holding on to that credit. And we're not talking about the management side. We're looking at just the entry for these positions. So you got about a 60% probability of just keeping the credit. You got maybe a 10 to 20% probability of hitting somewhere in your sweet spot. So if it's a 5 by 10, you got about a 20% shot of reaching, somewhere between $0 and $5 of added profit in that max profit range, somewhere in that range. And then, somewhere around a 20% risk to whatever side you're on. If you're doing this on the call side, it'd be the upside. On the puts for the visual on the downside. But you've got about a 20-20-60 breakdown of your probability. 60% keeping the credit, 20% hitting that max profit zone, and then 20% risk on this position to whatever side your short spread is.
Mm-hmm. And this again goes to what you're trying to do and get out of the trade. If there's a lot of time left with these options, that peak isn't going to reflect the true peak max profit. You need extrinsic value to be out of these spreads for that for this risk graph to be realized. So again, if you're trying to play for a downside move, maybe you go with a shorter duration with a spread like this, where if you go with longer term, you have more flexibility to flip this into a free butterfly.
Yep. All right, jumping to the next slide here. So, that's just a setup for the single butterflies, and I've been doing like multiple butterflies and doing all this crazy stuff in here, and that's kind of what we're focusing on here. But
you're making mountains out of butterflies. That's what you're doing.
Yes, they're low probability trades, but I've hit them. I've been hitting them, which is nice, but we're going to talk about these positions as a whole. So when you add, so in our last example, if you're starting with like a broken wing butterfly on the call side, you have that risk built into the upside. And this is the same when you have a short call spread and you want to go add a short put spread to make it into an iron condor. You can only be wrong on one of those spreads. So we can add risk to the opposite side equal to the risk that we have on the first entry, right? So if the example here is if we start with a call broken wing butterfly into an up move, we want to do this into, a move. You want to be getting short delta at higher prices, long delta at lower prices. If we get that up move, let's say we put on a call broken wing butterfly, if you get a move away from your spread, so this would be to the downside, over the next couple days or weeks, if the stock goes down, you can add a similar sized broken wing butterfly on the put side without using additional buying power. So this is what I've been doing with my XOP positions, which we'll look at in a couple slides. But basically into up moves, which we've seen, oil has super high implied volatility. It's been moving around dollar chunks minute to minute, it seems like. But into up moves, I'll add a call broken wing butterfly. When we get a down move, I can add a put broken wing butterfly. I can take off some of the risk, which we'll look at as well. But the key here is that we're just adding these into movements in the stock, into strength of our position. In this example, buying into weakness, right? So if the stock's going up, you put the call broken wing butterfly on. Stock starts going down, you put the put broken wing butterfly on, you're adding long delta into weakness of the stock, you're buying into weakness. This same idea applies to managing the positions, right? So just like in the original opening position, if we do the call broken wing butterfly, getting a little bit of short delta into an up move, if that stock goes down, stock or ETF goes down, buying in that risk or buying into weakness is going to get cheaper for that spread, right? So if you have a short spread, if you're just doing, selling a call spread and the stock goes down, to buy that call spread back and close it is cheaper. I mean, that's just intuitive. Stock goes down, you add short delta, that position gets cheaper. The same idea applies to these broken wing butterflies in that the short spread that you have on the upside that's wider than long spread is going to lose value, and we could buy in that position, that risk, into the directional move in our favor away from the stock. And that's kind of how I've been legging into these positions in XOP. Just kind of playing that two-sided action here.
Yeah, so turning a 10-point wide credit spread into a 5-point wide credit spread in the same expiration cycle. That's basically what you're doing when you're freeing up this risk and creating a free butterfly. It's going to be cheaper if the stock's rallying than if the stock's going into your spread. That makes the spread more expensive.
Exactly. So jumping on to the next slide here. So with my position, I mean, that's just a visual of the one that I've been just met.
Yes.
Do you like that?
Yes.
And so when you look at this position, the same sort of probability analysis applies to this position. And I've taken some liberties here. We've rounded numbers. You know, I've probably got a higher percentage of hitting these sweet spots and a little bit more risk than what is here. But, you know, generally speaking, this is what you're looking at, right? And it's synthetically, we've talked about this as kind of a strangle type position where, you know, it's a high probability trade. You're giving up some of that credit if you're in the middle of this position, which is the highest probability spot, in exchange for a higher profit potential if you get to your peaks, right? So hitting the peak on either side is a low probability shot. It's probably a 10, 15, maybe 20% shot of getting to one of those peaks, but it's generally low. The more probable outcome here is that we're somewhere in the middle and I won't be hitting that max profit zone here. So it's, you know, that same sort of breakdown as we looked at in the second slide, but on both sides of the stock here if you kind of put them together.
Yeah.
Go on.
And
Mikey.
really quick, the reason why you say 10%, 20% to hit those peaks is because your peak zones are relatively wide.
They're wide here, but they relative to the whole distribution, it's tight, right? So like you've got that small max profit zone on both sides, where the more likely outcome is in the middle.
Right. But if you had 1 point wide debit spreads, then it would be 1%.
Yes.
That's why we say minimum of $5, so you have a little bit of space. If you have a $5 wide debit spread, you really have 10 points from where it starts to where it ends for where your profit zone is and where your risk starts.
Yes.
Where if you have a 1 point wide, you have a 2 point wide range. And the more range you have, more space you have, the greater these percentages can be.
Very much so. Perfect example. So on this position as a whole, you know, the question is, what am I doing with this position? What's the plan? So here's the plan. Here's the management. This is exactly what I'm going to do. So you should be planning to hold this up until expiration. You know, at the very least into the last week or 2 weeks. You can see this has, this is in December, which is 17 days to go till expiration, I believe. Let me just make sure. 17. Yeah, December 16th. You got 17 days to go till expiration. I'm going to be holding this for at least another week, if not all the way till expiration. I'll probably hold this all the way to expiration. Where is my sweet spot on this position? Because we have a ton. You can see all the options here. I don't need to know the exact strike. I don't need to know the exact transaction of each of these options. I can figure out where my sweet spot is, and obviously we have the visual here, so it's easy to see, but you can, and we'll, on the next slide, we'll kind of break this down so you don't have to look at a visual like this, but you can see when you have multiple positions, I know my long options don't have risk, right? Those are defined risk. Their risk is just whatever you pay for them, and I'm doing everything for credits. So I don't have any risk on the long options if they all expire and go to zero. There's no risk because I'm doing this all for a credit. So where's my risk on this position? It's the short options, right? And I have multiple short options, but I can see that they're all kind of bunched together, right? So, you know, I've got a couple puts at 145 or 143, 140. That's my sweet spot. I don't know exactly where it is from this visual, but I know somewhere in the 140 to 145 range is where I want my positions to be, because my long options will hold value, my shorts will hold very little value or no value, and then everything else expires out of the money. Same thing on the upside at 160 or 165. Yes, some of those positions will be in the money, they'll hold some value, but I have all those long options that will also hold a lot more intrinsic value. So my sweet spot here overall is right where the shorts are, and that's the same, or in between the shorts, really. And that's the same with any sort of short premium position, whether it be an iron condor or a strangle. So when I look at this position, just isolate where your shorts are. That's where you want the stock to end up. That's your sweet spot.
And is it fair to say that from beginning to end with these strategies, you might start with a put broke wing butterfly with 30 days to go. On a rally, you free up the risk. When you free up the risk, you throw on another one. Call side, maybe put side still, depending on your assumption. Then if there's a sell-off, you free off that risk. So your intention is always to free off the risk so you can throw on more.
Yes. to give yourself more shots,
Yes.
right? I mean, these are all lotto ticket type trades.
Until you have 1 million lotto tickets.
Until you have a lot of lotto tickets, and then hopefully you can hit them.
Yeah.
So yes, exactly, Mike.
Beautiful.
And that's kind of to the second point here. So into big moves in either direction, you can consider closing out some of these long spreads, right? So if we get a move up to 165, let's say, I've got some long options at 155, 157, 160. Those are going to all gain value up to 165. That's all intrinsic value. The put side is going to lose value, right? It's going to get, those might trade at 20 cents, 30 cents, whatever the case may be. Those long spreads to the upside, they can only get to a certain value, right? If I'm long the 150 and short the 160 or the 155 and short the 160, it can only go to $5. If it's trading at 490 or something like that, I can consider legging out of those positions. You're capturing that value, but I've still got my downside shots as well. So you can kind of massage this position in that if you get moves to either direction, you can take the profits and the value off the table on those positions and kind of leg out of these as they go.
Yeah, and that's because these are all really defined risk positions. So
Yes.
if you get a debit spread that reaches max value
And defined reward.
Yeah.
That's the key too.
Mm-hmm. And you can, just like you can, if you sell a put spread and you collect or you keep, or the spread loses 90% of its value, you have 10% more to make, everything else to lose. So it makes sense to consider closing it. Just like a debit spread, if you have a $5 wide spread and it's trading for $4.90, you can only make 10 more cents, but you can lose that $4.90 on a sell-off. So massaging the positions really comes down to closing out of debit spreads that are close to max value and closing out of credit spreads that are almost worthless.
Yep. And then the last point here, and we've kind of touched on this already, and this applies to, let's jump back to the last one. Sorry, guys, just real quickly to go over the last point on the fourth slide. But we can do it here. Closing out of these positions, we're ignoring the specific transactions that we got into the, entry points that we got into these positions, right? So that out of the money long options, they expire worthless. And this goes to the entry of these positions. They're all done for credits. So if everything expires worthless, you're still making money, right? I mean, there's going to be some sort of intrinsic value here, but assuming these were all out of the money butterflies, they expire worthless, you just keep the credit, you don't have to worry about it. So the key here is that you're closing and managing the positions that are holding some sort of intrinsic value when we get to the point of closing these trades. We're not looking at those out of the money options that expire worthless. We're looking at everything that's got intrinsic value, those long spreads that are in the money, the short spreads that are closer at the money. It's important to look at this position as a whole, and this is kind of what we're looking at on this slide, right? So we're looking at this position. If you didn't have a risk profile of this like we have on the analysis mode, you can see where your risk is, right? So my sweet spot, and I did this calculation for you, if you have multiple short options, you can just take them all together and just divide by how many you have, right? So this is kind of how Tom will manage his positions if he's closing out of 3 different short options and rolling to 1 strike in the next expiration. That's because he's taking the same position and just kind of flattening it out onto 1 strike, right? So if you had the 161, the 163, and the 165, and you had 2 of each of them, just like I have, that total is the same position as 6 of the 163s. And I know that's kind of funky to think about because you'd say to yourself, okay, well, what happens if you move to 163? Well, you're getting more credit on the 161s versus, the 163s if you were selling those options in the same transaction. So this position as a whole is 163 in the upside. On the downside, we're looking at like 141. I just did this by taking all the strikes and dividing by the number of contracts. If I didn't have the risk profile, though, I could look at this, list of all of my options and isolate where my spots are, right? So the middle spot, the 60% shot, that one is right where all my long options are. The 10% shot, those are right where all my short options are, and that's where my risk starts to get realized, is when I get past those marks and we go to those out of the money long options.
Yep. So yeah, if you have a bunch of positions like this, you look at the shorts, that's where your max profit zone is, but that's also where your risk starts. Below the 140 put, above the 165 call, then you take into consideration the credits received and the intrinsic value, which is why the image shows you a little bit wider of break evens relative to what we're seeing here. But yeah, you can simplify it as easily as this, and then eventually you get to just a magical mountain peak.
Yeah. This one still has risk. So if we get big moves to either direction,
Yeah.
there is risk here. But as you manage these positions, this is how I approach this and how I look to manage this going forward.
Perfect.
That's it. So hopefully we hit that somewhere between 135 and 170 on XOP.
I'll be watching. I'll be rooting for you.
Thank you.